The Intelligent Investor is considered by many to be the Bible of value investing, and even Warren Buffett called it the best book on investing ever written. It is a great book, and while it is true that this book contains very important teachings, it is also true that it is not necessarily the best book for beginners. This is for several reasons. The book uses a rather technical vocabulary that can demotivate many people who are just starting out in the stock market. In addition, it focuses mostly on the United States and relates many historical or economic events that most people in other countries are not familiar with. And finally, and perhaps the most important point, is that it is a book whose last edition was published in 1973. While some of its ideas are timeless, many others are outdated. For example, one of the criteria Graham recommends to conservative investors is to avoid buying stocks trading at more than 1.5 times book value. If you had followed this rule over the past decade, you would have held only insurance or bank stocks in your portfolio. That would be a blunder. The book is full of wisdom, perhaps more than any other book ever published, but as an investment guide it lacks updating to today's metrics. Graham was constantly experimenting and testing his assumptions, always looking for systems that worked. But the world is always changing. Each edition of his book discarded previous formulas, introducing new formulas with each publication. Graham replaced his 1934 investment guides in different years, until 1976, when he died. Since then the book has not been updated. If his formulas were discarded and replaced 5 times in his lifetime, it is logical that some formulas dating back to 1973 are not valid today. In this video we will summarize some of the most important teachings of the book, but we will also talk about its actuality. We will briefly explain the formulas presented in it as a summary. Let's begin. The Intelligent Investor. First of all, what does it mean for an investor to be intelligent? The term intelligent has nothing to do with having a high IQ or being better informed than others. But in Graham's words, it means having the patience, discipline and willingness to learn and to think for oneself. An intelligent investor is a person who knows how to make his own decisions, and has the ability to control his emotions. And what does it mean to be an investor? Graham believes that the word investment is often misused. Not everyone who is active in the stock market is an investor. To a speculator, for example, stocks are nothing more than prices. Speculators bet on trends, and focus on momentary stock prices, not necessarily their value. If someone has ever recommended you to buy a stock because it is rising in price or because its trend is upward, and it has broken some resistance, that purchase recommendation is totally speculative. According to Benjamin Graham, an investment operation is one that is only carried out after a thorough analysis, which promises the safety of the capital together with a good return. A stock is not just a symbol or a chart that goes up and down, but a share of a real company with an underlying business model. It is necessary to thoroughly analyze the company and the soundness of its business before buying its shares. Mr. Market. Imagine you are the owner of part of a business for which you paid 1,000 euros. Every day, a certain bipolar person called Mr. Market comes to your house to give you his opinion on how much your part of that business is worth. And as if that wasn't enough, in addition, he offers to buy your share or sell you an additional share. But Mr. Market is constantly changing his mind. For example, at the beginning of 2020 he estimated the value of your share to be only $500. Months later, towards the end of the same year, he was ready to offer you $2,000. All this despite the fact that the company's revenues did not change significantly during that period. Blindly believing in Mr. Market valuations is a mistake. Let's remember one of the fundamental principles of Graham: a stock is much more than a chart. It's about real businesses, and as a market it is not always rational. The underlying value of the business may differ from the price he is willing to pay. In fact, the price the market offers is usually well above or well below the value of a business. It all depends on his mood. We should not let ourselves be infected by the emotionality of Mr. Market. Graham advises to invest in a business only if we feel comfortable owning it, regardless of market's opinion of its value. Remember that although Mr. Market is always offering to buy our shares or sell us more, we are not obliged to make any kind of transaction with him. We should take advantage of this, to buy when the prices offered by Mr. Market are ridiculously low, and sell when it is overvaluing the value of a company. It goes without saying that Mr. Market is the stock market, and that every time we look at the momentary price of a stock on the internet, we are receiving its offer, an offer that varies from minute to minute. Don't get carried away by your emotions. There is no reason to sell in times of panic or buy in periods of euphoria. Don't get caught up in the market's bipolarity and act rationally. Safety margin. We are not perfect and we can make mistakes. It may happen that we estimate the value of a stock to be $100, but we have forgotten to consider important data and the value of that company actually breaks $80. To minimize the risk of your mistakes, Graham recommends always buying using a margin of safety. What does this mean? For example, when building a bridge over with an average of 100 cars per hour travel, engineers will not take into account only the weight of those 100 cars. That would be very dangerous, as the bridge would collapse if for some reason more people were to cross the bridge. The engineers will develop a model considering any surprises in the future, a much higher than average flow of cars, etc. So when it comes to buying stocks, we should do something similar. We should cooperate as much as possible, well below our valuation price. Let's go back to the previous example. If we believe the stock is worth $100 and we buy for $50, we will have a significant margin of safety. Even if we are wrong and the value of the stock is only $80, we will have a juicy profit. Stock valuation is an inexact science, and that is why it is important to reduce risk. Types of investors. There is a big difference between two types of investors, which he calls defensive or passive investors, and enterprising or aggressive investors. Defensive investors. The defensive strategy is the most suitable for most people, since they have very limited time to analyze stocks. Graham recommends building a portfolio that invests in both stocks and bonds. Ideally, 50% to 75% should be invested in stocks and the rest in low-risk fixed income, such as government bonds. Depending on our capacity and willingness to take risks, and also on our financial situation, we can give a higher or lower weighting to the amount of stocks in our portfolio. When selecting stocks, we must follow certain rules. Our portfolio must have an adequate, but not excessive diversification, which translates into a minimum of 10 stocks and a maximum of 30. Each of the companies we choose must have a high capitalization. It must be a large company with a conservative business model. As of today, these would be companies with a market capitalization of at least $10 billion. The company's current assets should be at least twice its current liabilities, which is called the current ratio, 2-to-1. In addition, the company should have a long dividend history of at least 10 to 20 years. During the last 10 years, it must also have generated profits on its capital. Finally, they must be relatively inexpensive companies. Graham suggests not paying out more than 15 times earnings, that is, its PE ratio should not exceed 15, nor should it have a multiple greater than 1.5 times its book value. To average the entry price, monthly purchases can be made. This way we do not have to rack our brains deciding when to enter and when not to enter. As mentioned above, especially the points regarding valuation are quite outdated. We must remember that in Graham's time there were no computers as we know them today and no internet. The value of a company depended to a large extent on its book value. For example, its machines, buildings, infrastructure, etc. Something that does not apply to companies like Microsoft, Amazon, or Netflix. Moreover, some investors have gone so far as to declare the death of the PE ratio, given its little relevance today. On the other hand, an excellent alternative today for passive investors is simply to invest in index funds that are composed of large-cap companies and allow diversification across multiple sectors while offering the average market return. I will leave you a link above or in the description of this video with more information. The entrepreneurial investor. The entrepreneurial investor is a person who is not satisfied with the average return and seeks to beat the market, investing more time in stock analysis and normally incurring greater risks. Graham warns, however, that this is a very difficult task that only a few succeed at. An entrepreneurial investor must follow a quite different philosophy than a defensive investor. While he must diversify, he must do so to a lesser extent, otherwise his performance will tend to approach that of the average. He should try to buy when the market falls and sell when the market rises. In addition, he should not restrict himself to stable companies, but should also select growth stocks, as stocks of companies that have potential and have not yet established themselves. In doing so, Graham suggests the following formula. Companies in the portfolio of the entrepreneurial investor should have current assets of at least 1.5 times current liabilities. And debt should not exceed 110% of net current assets in the case of industrial companies. The company must not have a deficit in the last 5 years. It must pay some dividend at present. Its profit growth must be higher than in previous years, and it must be trading at less than 120% of net book assets. Thanks to the internet, we can very easily find all this kind of financial data about a company. But the same criticism applies here. If only it were as easy to select stocks based on quantitative criteria as Graham mentions. Anyone with advanced Excel or programming skills could beat the market. We must remember that things were very different in Graham's time. Following these kinds of formulas probably won't help us that much today. However, one thing has not changed: the fact that it is extremely difficult to beat the market average. The vast majority of professional and private investors fail to do so. But that doesn't mean it's impossible, because even if Graham's formulas are outdated, his teachings about Mr. Market, a margin of safety, and the need to control our emotions are timeless. Most people lose money in the stock market, not because they don't know how to use a calculator or look up the necessary ratios on sites like Morningstar, but because they don't have a clear investment strategy. The vast majority of people panic when their stocks fall more than 5%. In early 2020, for example, many people took Mr. Market's offer and sold at a panic-driven loss. But that was precisely one of the best times to buy quality stocks at bargain prices. Not only bad companies fell, but also excellent companies. Today, almost a year later, most companies have recovered and the people who sold cheap are buying the same stocks, but now at much higher prices. Quite the opposite of what Graham recommends. You must learn to control your emotions and, above all, to have discipline and think long-term. If you do not have the knowledge or discipline to withstand the ups and downs in the stock market, perhaps passive investing with funds is a better alternative for you. The Intelligent Investor is a very long book, so we have only covered some of its ideas. If you have time and want to read the most famous book on investing, I recommend you take a look at it. I hope you liked this video. Like it and leave a comment so it can reach more people. See you next week, and remember, smart work is the key to success.